Hey traders, welcome to Charts and Coffee. Hope everyone is having a great morning. And my Thinkorswim decided to hang on. We have no charts for Charts and Coffee, but we do have coffee. Hope everyone is enjoying a big mug because we are in the here we go. We're gonna trading view it up today. All right. So we're in the aftermath of the PCE, and we have two very interesting days coming up. One is the aftermath of the inflation data that the Federal Reserve uses for their models. We're talking about the inflation data, not of Earth, right? We're not talking about, I always joke that if you were to look at inflation, when we go to the grocery store, you look at inflation through the lens of the PCE, and you look at the lens of the CPI, and it's very subjective what inflation is. So that's where I say this is not about the reality of inflation. This is not about the reality of this number. It's what does the Federal Reserve use in their models? And that's going to dictate what their monetary policy is. Now, in the last couple of days, we've had a lot of other members of the Federal Reserve, the FOMC, whose name is not Jerome Powell, speaking about their opinion about what needs to be done next, how hawkish or dovish they are. Hawkish, again, favoring either keeping rates higher, as they are right now, or hawkish as in wanting to hike rates, or dovish, which is to say favoring lower rates, more accommodative monetary policy. And as long as we've got mixed messages from the Federal Reserve, the equity markets are going to be uncertain. The treasury markets are going to be uncertain, as will the currency markets. And if you look at the S&P, say the long bond and the euro, it's a really great way to understand how an uncertain picture about when and how much we can expect the Federal Reserve to cut next year by, you're going to see how much uncertainty that just echoes throughout all those markets. Now, you might say, well, Rog, how do we even measure the way in which we have this expectation for rate cuts or rate hikes or whatnot? I'm going to take you on over here, gang, to this is the Chicago Mercantile website. They have a fantastic free link. In fact, if you were to search CME FedWatch tool, which you can, it'll land you on this page. And here we can see a tab for every one of the meetings. Right now, is the December tab, the December 13 tab, all that important? No, in 2 weeks, we're going to find out from the Federal Reserve that they're going to pat themselves in the back a little bit about bringing inflation down. They're not quite certain about the number, although I think we have to have a little bit more certainty now. We'd like for Powell to echo clarity about what we're supposed to think about today's PCE. We'll get to that in a moment, but it's 95%. Even if I did not look at the PCE number. By the way, I purposefully did not look at the PCE number. I looked at the S&P reaction, I looked at the NASDAQ reaction, I looked at the ZB so we could do it here together, so I could really emphasize the fact that I don't give a rip what that number is. I only care how it's being responded to. The response that is most important is right here. 96% expectation that we're going to hold. But this isn't really where the drama is. Right? We actually move out to January. That's another hold. That's not been anything other than a hold, right? We have not ever thought January could be where the rate cut comes in. Take a look at March. All of a sudden, see that 500 to 525 column? Gang, this is macroeconomics. If you want the bouillabaisse of what it is, this is it. This is how easy it can be, right? 42%, 42.5 versus 54.5. Gang, this is actually looking like the conversation may not be probable for the quarter point hike, but it's now really starting to become a conversation, right? You go into May, gang, May is now nearly fully discounted. I would say it's fully discounted because if you look at the 5 to 5.25, right, that's quarter point lower than where we are right now. And you look at the 475 to 500, you add those two numbers together, we're 75% expecting some sort of move on rates to the downside. Call it 25% expecting that we hold. So you can see the May meeting, that May 1st meeting is now really leaning dovish. And again, do I care what the PCE number is? Do I care what any of the Fed members said? No, because at the end of the day, this is reflecting, and here's what's so important, gang. Here it's communicating what we as traders and investors are telling Jerome Powell and company. This is what we're expecting you to do. And I've talked quite a bit the last few weeks about when Powell ignored Fed fund futures, when Powell ignored the sentiment in the market. And that was in Q4 of 2018. And if you want to go see, well, you know what, we could do that together, but I'm sure a lot of you don't need to relive what 2019 Q1 looked and felt like, right? That's what happens when the Federal Reserve defies expectations about what the Fed fund futures are telling the Federal Reserve. And believe me, all those chuckleheads, their Bloomberg terminals, can see what the Fed fund futures are reflecting, and the Fed fund futures are going to move every time we get data on employment. So think JOLTS, think non-farm, and every time we get inflation data. Now you'll notice GDP has been a non-starter. And you know why? Because Jerome Powell has redefined what a recession is. That word does not even mean anything anymore. So when that word's thrown around, it's just to grab attention in a very clickbaity way, because Jerome Powell and the Federal Reserve have just redefined what it is. So it doesn't mean anything anymore. Therefore, we stick with their dual mandate, which is let's get inflation to levels that we have told traders and investors we're aiming for. You know, what is our goal for the economy? And let's not break employment on our path to it. And that includes wage growth. And that's where we are. And that's it. That's where we are. So ultimately, what we want to remember is that's the reality that we're trading. It's not the reality of the Federal Reserve. It's the reality of it's not our reality. It is the reality of the Federal Reserve, right? Okay, so with all that being said, that's a heck of a ramp up. But this is the most important thing of the morning, gang. And I find a lot of traders start to speculate things like, well, they're not going to cut in 2024. I think there's more probability that they will based on the data, right? Then there's conversation of, well, you know, whatever the speculation is, I guess my plea is let's stick with the data, right? Let's stick with the things that we know the Federal Reserve is looking at and we can measure with. And when the rate of change starts moving away from March, moving away from June, and moving further out into the year, or more likely, if we're going to see a hold, it would be something that would show that inflation's hotter, right? So you might say, well, Rog, what is the scenario that we could see inflation moving the expectations we have for rate cuts? This PCE would have to be not moving lower than the previous 0.3. It would have to be moving higher, right? So not only are we lower than the 0.3 previous, right? Our forecast was 0.2. We got 0.2. And so that's kind of what I'm saying here, gang. Let the data determine, not speculation. And look, this is even fantasy football works on data. I see more data and research going on in fantasy football than I do half the discussions about the equity markets, where people want to guess and hypothesize and whatever else. Work with the data, right? So that's what I'll say there. All right. So as always, gang, best part of our show are your questions. I hope it makes sense. I hope it's something you feel, oh gosh, I can do this. I don't need a degree in economics to understand how to do this. Just use the tools that are at our disposal and trust the data. Trust your gauges. All right. So good morning, good morning, good morning. Alex says, so the market yawned at inflation numbers. What to make of that? So if we expect 0.2 and we get 0.2, you know, where's the reason to panic, right? And here is the S&P on a 5-minute chart. And so what's the reason to think anything other than we braced ourselves for that 0.2 and we got the 0.2. So when we get what we expect, there's no surprise. There's no surprise to the upside. There's no surprise to the downside. There's no reason then, Alex, to make sudden and abrupt adjustments to position our expectations. So That's it. The Nasdaq stuck around 16. Look, I think there's a lot of discussion about, how do we project where a market is going? And I've never cared. You might say, whoa, Rog, what? You've been a trader for 30 plus years. You don't care where a market is going. No, I care about the probabilities of the obstacles, right? So what does that mean? Support and resistance, we all track via different methods. We can use time, price, volume, volatility, a combination of all of those, which is ideal. But those are the four factors of the market. The more of those factors we use, the more thorough, more four-dimensional view of what's happening we get. Most traders stop at price. Smarter traders add time. Great traders have volatility and volume incorporated. I've studied the greats. That's what they do. The more of those four dimensions you've got, the better off you are. So, okay, Rog, how do we study volatility? I look at a 6-month historical volatility. This is something we've been talking here about. This is unique to Simpler, right? What I've done is I've gone back, and big shout out to the Lorna bot for really helping me fine tune what this is to a level at which when I look at hourly price movement ranges, never in the 10 years that I've been using 10 plus now, in about the last, gosh, how long have we been automating this now? It's a blur. So in the automation of it, the numbers are getting not just accurate in terms of the distance between the volatility-based resistance and support, but the zones themselves, right? Between 8 and 9 a.m. on Thursdays, we're going to see this wake up. It has to, because of the kind of data we get between this, in this hour of the day. Notice how things are so much more sedate before that, because historical volatility tells us that is the nature of, say, about 2 a.m. to 8 a.m. Eastern, right? So if I think about what's happening with volatility, and then I add volume into the mix, right? Is the NASDAQ stuck? It depends on the time frame, right, Alex? It depends on the time frame that I'm looking at. Take a look at, this is the 5-minute time frame. Let's change this to a 1 hour. And, we're in an uptrend on, hang on, why is this coming up as Tesla? Let's try this again. I clearly have undone my symbol link here. Okay, so here we go. Is this stuck? It was in an uptrend, and then now it's gone sideways, but it's above the 200. So Alex, I'm still going to make bets on the NASDAQ moving higher, right? Same thing goes for the daily. And hang on, let me get this symbol link hooked up here. Here we go. I don't need an interval link. I need a symbol link. There we go. All right. So when I take a look at what's happening on the daily time frame, let's pull up the daily of the NASDAQ, right? It's, to your point, it's sitting in a range, but I'm going to ask myself, where is the volume, say, in November? Take a look at these volume ledges. There's a lot of volume. There's my point of control right now for the month of November. See that orange line cutting across the daily? That is where the most volume has occurred. It does have a certain magnetic pull. It's a tractor beam. It's a gravitational pull. Anyone can pull this up. And I'll tell you, there's 2 ways that are really powerful to do it. And I've taught everyone how to do this in previous free videos. One, volume ledges. Use visible range volume profile on TradingView or whatever volume profile you have on your platform. Understand where the point of control is and where other large volume spots, I like to call them ledges, are sitting at. So you can see there's another ledge sitting at about 15,900 to 15,850. There's another volume ledge there. The next thing I'll tell you to do is, especially as we go into options expiration, look at open interest on the put and call side. I have a video where I walk through every single step of how, if you wanted to pin, if you wanted to understand the gravitational pull, where price is going to be pulled to, open interest, price-based volume. Boom, there's your magic decoder ring. So that's what I'll look at there, Alex. I know, big kind of answer to that question, but that's all I can look at. Does it break after the end of the month? I think there's a higher probability, yes. Think about the seasonality of redemptions at the end of the month. The last 3 days are statistically where most redemptions are going to be. Last 3 trading days, which were in the last one. So redemptions are going to affect, to a certain degree, price action. Redemptions is selling, yeah. But as we go into the next month, as we go into window dressing, Absolutely. I would, again, not predicting anything, but not only will I say we'll likely break 16,000 and stay above it, 16.2 is probably a pretty easy foregone conclusion if window dressing is going to hit the NASDAQ, right? Where you really, right, this point have 6 out of 7 of the Magnificent Seven moving and grooving. I wouldn't call Tesla moving and grooving yet, not yet, because it's one of the few individual stocks that is not in an uptrend. But if you ask me, Rob, window dressing, yeah, keep an eye on pullbacks to buy on Microsoft, on Meta, on Amazon. So that's where I want to look for those pullback opportunities. And I would love a little bit of weakness, Alex, and then I'll buy the dip. All right. Tony says, I trade futures and it's kind of frustrating to exit a position for small gain and see it proceed to pop in my intended direction afterwards. Tony, you know what? I think everyone shares the opinion that winners are always too small and losers are always too big. And that is the math of the markets. However, that being said, in order to be, my opinion is this, in order to benefit from a prolonged trend, there's two things that you can do. One, why would it follow through, right? Are we trending or are we not? If we're not trending, I'm not going to have higher expectation for follow through. If we are trending, I'm going to look for higher expectation for follow through. The second thing is, as it follows through, do you have multiple contracts so you can pay yourself along the way? I don't add to winners, right? I actually enter with my largest number of contracts in a zone where I know where my stop is predicated to that entry. And then as the market goes in my favor, I scale out. I pay myself, I reduce risk, I realize profit. So I think really it's two things. One, why would I think we're going to follow through, right? Why would I think there's likelihood for that kind of movement? And that's going to be really highly contingent upon, do I have a trend or not? Because if I don't have a trend, why would I assume continuation? And then that is more probable. And the other thing is, am I entering the position in such a way that as it goes in my favor, I can pay myself and scale out as it goes? All right. Next up is, quick reminder, gang. If you haven't yet grabbed whatever goodies from the Simpler Trading store that you've been wanting, take advantage of the sale. And I mentioned this to my members in the mastery too. Anytime you want to take advantage of the sales, I think courses and our sales, and I think this is the biggest one of the year, are the best time to do it. And my theory is this: if there's something you want, save some money on it. The money you save goes into your trading account, and I am all for that. All right, Munair says, did I purchase stock for the longer term XLK? So we were talking about the weekly time frame yesterday, right? So in my longer term positions built on weekly, yes. So just to give everyone a little context for Munair's question, and it's a great place to end. We have 4 different types of styles of trading that we do in the Sector Secrets Mastery. I day trade, as do many of you. We day trade, we swing trade. We have our longer term position portfolio where, yes, Munair, there's shares, and the Lorna Bot scalps. Lorna Bot has a process that is very complementary to what we do in the mastery, and we have a scalping approach. This is the longer end of the time frame and time horizon, Munair. And yes, I buy shares when I do this. So what we did last October, we send out an alert to members. We say, hey, look, it's time to start scooping up some XLK in this area in here. And that's exactly what we did. So when people say, do you have XLK? I think what's more important is, where do you have XLK from? What is your cost basis? $121 and I think 50 cents is my cost basis. So yes, shares, because I want to be able to hold this for years, minimum 6 months, but potentially for years. This has been a holding we've had now, as you can tell, for 13 months coming up on, So I don't trade the options. I don't want a depreciating asset in a portfolio that I, want to be able to hold this thing for years, if not longer. So I don't need that breathing down my neck. All right, gang. As always, thank you so much for being here for Charts and Coffee. Be good to each other. I'll talk with you soon.